Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I had money, would I buy or would I pass? Before we start, don't forget to subscribe to get info on new episodes and other videos. So let's begin. So like always, I'm going to use the website known as lazyfa.com, which allows me to see the financial documents in a visual perspective and makes this episode go pretty quick. So today, the company for today is going to be MU, also Micron Technology. A lot of you guys might know this, the memory company. So let's begin. All right, so we're here in the dashboard. Let's start off by looking at the income statement of the company. So right in the income statement, this is where we see the revenue, the amount of money is collected from sales, the cost of revenue, which is the amount it costs for those sales to go, the gross profit, which is the difference between the two, and the net income, which is the total money received after everybody gets paid, taxes, and everything. So let's take a look. So revenue, we're going to take a look at the annual information. So from 17 to 18, revenue went up from 20.3 billion to 30.3 billion. So it revenue increased by 50%. That's really good to see in a company where the cost of revenue did not increase by much. We have 17 about 11.9 billion, and on 18 we have 12.5 billion. So the cost of revenue has not increased as much as revenue itself, and we can see that right here in gross profit. Last year, gross profit was about 8.4 billion. This time it was about 17.8 billion. That's about over 100% increase in profits, which is good to see in a company. Net income, which is the money collected after everything was paid off. This company got about $14.13 billion of net income, compared to last year, which was 5.9 billion. So again, this time it increased about 300% in net income. If I was just to look at this company based on income statement, I definitely would buy. Everything's looking pretty green for the company. Let's take a look. So now we're going to take a look at red flags. This is something new Lazy FA has come up with, and it's just a different way to see a lot of this information. So like I mentioned before, revenue versus cost, we can see it here. The green bar is revenue. It's increased pretty dramatically, while the blue bar, the cost of revenue, has not increased as much. If we look down, we can actually see a percentage-wise this past year, revenue growth increased by 50%, cost of revenue increased by 5%. So that's really great things to see. We can see again here gross profit about again increased over 100%. So for me, based on income statement, this is looking like a buy. We still got some other sheets to take a look at, so let's take a look at balance sheet. Here we're going to see the total assets of the company, so what they own, how much inventory they have, and then we also get to see the liabilities, the debt, how much they owe, payables, receivables, and stuff like that. So now total assets, 17 to 18, they increased their assets by about $8 billion. We'll take a look in the next slide to see maybe if we can find out where that increased. But since 13, it's been a steady increase, which is not bad to see. We like to see this positive, or at least flatline. We don't like to see so much fluctuation happening, where the company is constantly buying and selling. So right here, this buying, it's definitely an indication of growth in their total assets. Total liabilities, I like this a lot. When from 17 to 18, look at that, it dropped from 15.85 billion to 10 billion. So it lost about 33% of its that down, right? So it lost $5 billion. It paid $5 billion of liabilities, which is good to see, right? We still have total assets increase, and that can also help the assets, right? And then here we can see why liabilities went down. Total debt of the company in 17 was 11.15 billion. Now it's less than 5. So it paid off about $6 billion in debt, which is really good. right? The less debt it has, the less interest it has to pay, the better for shareholders and stuff. So here, really good again, total assets. So we have total assets increasing, we have liabilities and debt going down, which is a great thing to see. And then one of my favorite things is cash and cash equivalents. So for those that don't know, cash and cash equivalents, this is just assets that the company can sell off pretty quickly to collect cash, right? You can't sell a plant in less than in such a short time. So that wouldn't be considered here. So these are assets that are able to be liquidized pretty fast, and also including cash. So from 16, 17, ever since 15, it's been increasing dramatically. It's 15 in 2017, it was about $5.11 billion. Now it's about 6.5 billion, an increase about 20% in cash and cash equivalents, which is really good to see. Let's take a look at red flags. So red flags, right? We have the balance sheet here. So similar, we can see total assets outweigh total liabilities, which is good to see. Shareholder equities, which is just assets minus liabilities, this is what the shareholders are pretty much paying for, has increased dramatically in the past year. Again, that's due to their revenue increase, their assets increase, and the liabilities going down. So anything else we would like to see here? Nothing here. So here, this is something I just realized that Lazy FA has, so asset distribution. This is good to see. We get to see where the assets gets distributed, and like you can see, let's take a look. It does seem most of their increase in assets has been from property, plants, and equipment that they bought. So in 2017, they had about 19.4. Sorry, let's see if I can click this and stay there. There we go. They had about 19.4 billions of assets based on property, plants, and equipment. Where now it's about 23.76 billion, which is good to see. One of the other things I like to look at is inventory. I don't want to see inventory increasing dramatically, so I'm actually gonna hide everything but inventory just to see how it's changed throughout. So inventory, right? I mean, from 3.12 billion to 3.6 billion. Inventory is not it's not a crazy factor of this assets, and that's really good. I don't want to know that a company is constantly holding inventory, because that means they're not selling something or they're holding something, holding back on something. So for them to only be increasing this little, it means inventory is moving out of the facility pretty quickly. So it's good to see. Liability distribution. This is where the debt liabilities are worth. So you can see payables. So this is what they gotta pay people. Tax liabilities, anything they have, taxes they have to pay. Current debt is that they need to pay within the next 12 months, I believe. I think it's within the year. It might be shorter, but it's current debt is considered debt that needs to be paid pretty within a year's time. Non-current debt is debt that needs to be paid at some later time. So we can see current debt is about 859 million. 859 million compared to the cash and cash equivalents they have is nothing one should worry about. This company has enough money to pay this current debt, no problem. So based on balance sheet, this to me would be a buy. So not gonna lie, Micron is looking like a really good company to invest. The only thing that Lazy FA does not show, which a lot of investors worry about, are guidance for the future. So I think memory is slowing down, so we might see a slowdown in this company, and that's why stock price might relate to current downtrend. But like I said, based on balance sheets, income statements, I don't see anything crazy happening in any time soon. So here, cash flow. This is one I'm not I don't really like looking at, but we'll take a look at it. The only one in net cash flow that I like looking is net cash flow from operations, and this is just the cash flow they're collecting from their everyday use. So right, I want to know that from operations, this company is making money, and we can see it has a positive cash flow of $17.4 billion, which is good to know, right? I really don't care if they're making money from investing or finances. Sometimes companies try to do some form of ways to reduce the taxes they pay, and they can write off stuff with investing negative and negative finance. So to me, that's nothing too insane to watch. But I just want to know that in net cash from operations is positive. Let's take a look at red flags for cash flow. I don't think there's anything I like to look from here. Yeah. So let's take a look again, a quick overview. Income statement, revenue is going up, cost of revenue is staying pretty plateau, gross profit has increased, net income has increased. So income statement gives me a buy. Balance sheet, what do we have in balance sheet? So balance sheet, total assets is increasing. We saw those total assets increasing based on increase of plants and not of increase in inventory, which is a good thing to see. Liabilities and debt has dropped down. Good to see cash and cash equivalents are high enough to pay down the current debt, and within the next year, it has more than enough. The current debt is about $800 million. We have about cash and cash equivalents of $6 billion. So to me, another buy from balance sheet. And cash flow, like I said, the only thing I look from here is net cash flow from operation, and that is looking good. So to me, MU will be a buy. So I want to know what you guys think. What do you guys think of MU? Would you consider it a buy, or would you pass on MU? I hope you guys enjoyed the episodes. Like I mentioned, Lazy FA makes it so easy for me to look at all this information. So it makes these episodes go pretty fast. I'm curious though, like I mentioned earlier, would you buy or pass on this company? Also, don't forget to subscribe, give me a thumbs up, and give me any comments or feedbacks you might have. Have a good night, guys, and see you tomorrow.